This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Here in Chapter 8, where we deal with partnerships, I certainly am very happy to say that the rules and the principles behind these rules have not changed. They haven't changed in a very long time, let alone from last year to this year. So once again, we'll be able to keep our recycling going and to use the lectures from last year. The only thing that you will find as regards the class examples, the examples here, there are separate class examples that I make up and show on the white screen. But as regards the chapters examples here, the dates will be slightly different. In terms of the dates here in the FA21 study notes that you are looking at, they are more recent accounting periods. But all that has changed is the accounting period end dates used for the accounting periods within the chapter. There's nothing else that has changed. The way that, as you will see, the tax-adjusted trading profits of the partnership are divided between the partners using a profit-sharing agreement during the accounting period, none of that has changed, nor is it likely ever to change indeed there. That is the same as it ever was. So in which case, just watch as I go through these examples from the study notes. In the lectures, we'll be looking at slightly older dates. Again, you should be able to use your own study notes and look at the current dates there. If you wish, just go through the examples as shown on screen and again follow that through. But as I say, when you do the examples from here, they are more recent dates. But apart from that, nothing has changed. So, for the lectures on partnerships, again, I'll hand you over to my good self as it was last year there. Again, enjoy. Well, at the end of Chapter 7, we summarise what we had dealt with over the various chapters involving the unincorporated trader, and also set the scene for what we'd have to do here in Chapter 8 when dealing with partnerships, and very specifically, partners within that partnership. You may recall, in Chapters 4 and 5, we learned how to establish a tax-adjusted trading profit through Chapter 4, the adjustment of profit exercise, and Chapter 5, capital allowances. In Chapter 6, we saw having got a tax-adjusted trading profit for any given accounting period, whether that be the first accounting period in which the business has traded, any continuing accounting period through which we trade, or indeed right through to the cessation of trading. We learned the bases of assessment that would apply for each tax year, the way by which we related a given accounting period or periods of profit to a given tax year in which that profit would be assessed. And then in Chapter 7, we learned about how to deal with losses. Should regrettably that adjustment of profit exercise end up not with the tax-adjusted trading profit, but with a tax-adjusted trading loss, what then could the taxpayer do with that loss? And we saw the various reliefs available to that individual. But throughout Chapters 4 to 7, we were dealing with an individual, an unincorporated trader, a sole trader. But of course, the other form of unincorporated trade that is common are partnerships. And that means that when we have, as we still will, do all the work, the same work in Chapters 4 and 5 to establish a tax-adjusted trading profit, before any assessment can arise, we must understand that having done the same Chapter 4, Chapter 5 exercise, got the tax-adjusted trading profit, that is of the partnership. But it is not the partnership that is then charged to tax. It is each partner who will bear their own liability in relation to their share of that tax-adjusted trading profit. It will be in the context of Chapter 7, each partner will be free to claim their share of any tax-adjusted trading loss. So there's one new exercise that comes in that punctuates the work that we've done so far that was relevant for the sole trader. It is having got that tax-adjusted trading profit or loss, how do we then divide it between the partners of the partnership in order then to establish each partner's share of the adjusted profit or loss in order that profits can then be assessed using the normal bases of assessment whether that be through opening years, continuing years, or closing years of that partner's membership of the partnership, we are able to establish for that individual partner their assessment again for any given tax year. Same bases of assessment as we saw originally in Chapter 6. In Chapter 7, we've now got a tax-adjusted trading loss, and each partner will be free to make their own decision about what to do with their share of the loss, which relief or reliefs to claim. Again, these are not the profits of the partnership being taxed on the partnership. It is not the losses of the partnership being relieved for the partnership. Each partner has established, we will establish for an amount of tax-adjusted trading profit, an amount of tax-adjusted trading loss, and the tax year to which that relates. So, here in Chapter 8, therefore, we've got this situation explained to us, and that deals with the key issue of how do we divide out the tax-adjusted trading profit or loss. So we know that a partnership is, of course, a single trading entity, but for taxation purposes, each individual partner is effectively treated as trading in his or her own right and is assessed on his or her share of the adjusted trading profit of the partnership. We will, for the start, the part of this chapter, be assuming that profits will arise. There is only a limited amount of knowledge that we need to have in terms of partnership losses. All the mechanical work will be dealing with profits. It is essential to understand, therefore, that it is not the partnership itself that is assessed upon its adjusted trading profit. It is each individual partner will be assessed on their share of that adjusted trading profit. So first thing we need to do, as we've said already, is establish what the tax-adjusted trading profit of the partnership is. And that is effectively the same work as we did in chapters 4 and 5. But the partnership's tax-adjusted profits or losses for an accounting period will be computed in the same way as for a sole trader. But do remember that any partner's salaries or interest on capital that are debited on the statement of profit or loss are not expenses. They are not expenses. These are not the salaries being paid there to employees of that business. These are owners of that business. They are partners. And all a salary or indeed subsequent interest on capital that may be credited to partners, all it is a way of sharing out the tax-adjusted trading profit. So we use the information in the profit sharing agreement for the accounting period in question. We use that in dividing out that tax-adjusted trading profit of that period between the partners, so that then each partner may be charged tax, may be assessed on their share of that adjusted trading profit. So salaries or interest on capital are not deductible expenses because they are simply an allocation of the trading profit by the owners of the business. So what do we do? The trading income, or if it were necessary, it won't be for us, trading loss, divided between the partners according to their profit sharing arrangements in force during the accounting period. So we will have adjusted up the profit from the statement of profit or loss for an accounting period. It is therefore that profit of the accounting period that is divided according to the profit sharing agreement, the profit sharing arrangements in force during the accounting period. Partners may, firstly, as we've said, be entitled to salaries and interest on capital. That would be the first share of any available profit credited to those partners, awarded those salaries and interest on capital figures. Salaries there for those who do more work in the partnership, interest on capital for those who put more capital into the partnership. Then the balance of any trading profit or loss would then be allocated in the profit sharing ratio, the PSR there. So all we're going to do get the tax-adjusted trading profit of the partnership and split that for the accounting period according to the profit sharing agreement in force during the accounting period. Now, some of you will immediately recognise that you've done this exercise before in accounting. There you were dealing with just an accounting profit, but you divided it, you apportioned that between the partners according to the self-same agreement. Were the salaries to be credited? Was the interest on capital to be credited? And what balance then in the profit sharing ratio? That would be credited out to each of the partners. All we are doing here in tax is taking not the accounting profit, but the tax adjusted trading profit. And we are splitting that between the partners, again, according to that profit sharing agreement in force during the accounting period. Now, all of this work needs to be done before ever you start thinking in terms of what assessment for any tax year will then arise in relation to any partner. We forget about tax years to begin with. We look at the accounting period and we split that tax-adjusted trading profit according to the profit sharing agreement in force during that period. Now, the sort of question that you would get to make life more interesting than just, again, another version of what you've done in accounting is, of course, a change in the profit sharing agreement taking place during the accounting period itself. So if that profit sharing agreement is changed, oops, that's a bit lopsided. If that profit sharing agreement is changed during the particular period of account, the accounting period of the business, then the profit must be time apportioned before allocation under the different agreements. So how many months worth of that profit under the old agreement? How many months of that profit under the new agreement? Now, the only thing that is an issue here, again, if you're going to make a mistake here, because this is purely a mechanical exercise, there's no theory involved, it's just mechanical. But if you're going to make a mistake here, what it would be is when you deal with those, the old agreement and the new agreement, the salaries and the interest on capital. Because salaries are per annum. Interest on capital, you're not going to work out now the full annual interest. It has to be time apportioned. So you need to look at how many months was the partnership profit split according to the old agreement. And if that old agreement was, say, 9 months, and there were salaries credited to partners, those are annual salaries. So you'd only take 9/12 of those annual salaries and credit them now to each respective partner. Interest on capital. Well, yes, we know the interest rate, we know the capital, and therefore we need to time apportion. You may be given, indeed, the figures of interest for the year. We just need to time apportion. How many months worth on the old, how many months worth on the new? That is a simple, a very basic time apportionment exercise. And what it means here is there's nothing that's difficult in terms of the learning, the technical aspect. It's just very time consuming. And we have to be very structured and organised in terms of our approach to be able to correctly get the numbers at the end of this exercise. Now, in a Section A question, there's a limit to the amount of time that you would have available, and therefore there's a limit to the number of partners you're going to have to deal with and the complexity of any profit sharing agreement, both old and new. So again, it will be time constrained, but what we have to ensure that we do, whether it's Section A, whether it is Section C, in Section C you would of course be showing all of these workings. We need to be structured in our approach if we're going to get the right outcome at the end of that exercise. So before I leave you to do example 1, let me take you through an example now, which we have already set up for you here. So we have got 2 partners, partner A and partner V, have been in partnership for several years. Now, important there that the partnership has been running for several years, because once we have established the tax-adjusted trading profit of the partnership, divided that profit between the partners, so we know each partner's share of the adjusted profit, that is the profit to be assessed using the relevant basis of assessment for these unincorporated traders, these partners. And if this, as it is a continuing partnership, then each of the partners will by now be using current year basis. So whatever accounting year end we're dealing with, once we have the tax adjusted trading profit split between the partners, each continuing partner will be assessed using current year basis. So what is the accounting year end? In which tax year does that accounting period end? And using CYB, it will be that tax year for which they are now assessed on their share of that tax adjusted trading profit. So we've got, therefore, these two, A and V, have been in partnership for several years, preparing accounts to the 31st of December in each year, with the most recent tax adjusted trading profits, these are the ones that are going to be relevant to us, being firstly for, which will occupy us for the first part of this example, the year ended 31st of December 20, where we had a £60,000 tax adjusted trading profit. Again, if you were dealing with a larger Section C question, no doubt there, you'd be provided with the statement of profit or loss for the partnership. You'd have to do your adjustment of profits, your capital allowances, get the tax adjusted trading profit, and then split it between the partners using the agreement in force during the accounting period. So we know that for the year ended 31st of December 20, there is the partnership tax adjusted trading profit. The profit sharing agreement in force until, now I said we're focused in this part of the exercise on the year ended December 20, because in that accounting period we have a change in the profit sharing agreement. Up until the 31st of August 20, so the first 8 months worth of that accounting period, partners A and V were being credited with salaries of respectively £24,000 per annum and £18,000 per annum. The profit sharing ratio between A and V was simple. It was a 1-to-1 split. But then from the 1st of September 20, so September, October, November, December, the last 4 months of this year end, the profit sharing agreement changed to salaries. Well, we've evened up the salaries. Now both of them have £24,000 per annum. But the profit sharing ratio, instead of being 1-to-1, is now split 3-to-2. And what it is our task to do is to calculate each partner's share of the tax adjusted trading profit of the year ended 31st of December 20. Now, only once we've done that exercise, and only if a question requires you to do it, would you then attempt to establish, so, partner A's share of that profit of 60, partner V's share of that tax adjusted trading profit of 60, how will we assess those profit figures on each partner? Using CYB. So the year ended 31st of December 20, that ends in 2021. So it is that period which the current year basis will pick up and assess for the 2021 tax year. So with the income tax computations for the 2021 tax year, for each of partner A, partner V, you would now include as their trading profit, their trading income assessment for that tax year, their share of that partnership profit of £60,000. But it is our task, of course, to find out what that share is, on what figure will they then subsequently be charged to tax, assessed at tax in the 2021 tax year. Okay, now I said to you this was a very mechanical exercise here, and it is. There is nothing in the way of technical problems here. It's just how do we structure our answer. So, depending on how many partners there are, here there are 2, and we'll need a total column. We're going to need columns for each partner and a total column. Now, whether you put the total column as the first or last column doesn't matter. But we're going to have total, and we're going to deal then with each partner, partners A and V. The accounting period that we're dealing with, first of all, was the year ended December 20, for which period we had a £60,000 tax adjusted trading profit. Now, if there were no change in the agreement during the accounting period, you'd just be crediting the full annual salary. Here, apart from PSR, that's all there was. But if it were relevant, you'd credit a full year's worth of interest to each partner. And then you just split the balance in the PSR. All that we've got to do now is to split this accounting period into how many months on the old agreement and how many months on the new agreement. So our old agreement ran from the start of that accounting period, so the 1st of January 20, all the way through to the 31st of August of 20. So that, as we know, is some 8 of those 12 months of that period times what is the annual figure of 60,000. And that therefore means it is just 40,000 of that 60,000 that now needs to be split according to that old agreement. What did the old agreement call for? It called for salaries and then the balance in the profit sharing ratio. What were those salaries and how much of those annual salaries should be credited? We know it, it's 8 months. So we would take 8/12 times each annual salary figure. Now, I think the two salary figures that we had were 24,000 and was it 18? Yep, there we go. 24 and 18,000. So we want 8 months worth. We want 8 months worth, therefore, of those particular figures. And again, the same problems arising as before with this machinery. That, again, if I can just get you to pause at this particular point, I shall try to restore this technological equipment to its former glory. Bear with me a moment. I am a technological genius. There we go. We have restored it to its original former glory. So we've agreed that the old agreement lasted for 8 months of this 12-month accounting period. The old levels of annual salary were 24,000 and 18,000. We therefore want 8/12 of those figures credited to the respective partners. 8/12, 2/3 therefore of 24,000. So partner A gets credited with 16,000, and 8/12, 2/3 of 18 will be a further 12,000 credited to partner V. So in total, out of the £40,000 available profit to be split between the partners, we have credited so far £28,000 of that profit in the form of salaries. The only other thing that is left is the profit sharing ratio, which was a very simple PSR of 1:1. So the amount of profit for this first part of the accounting period under the old agreement, that totalled 40,000. We've dealt so far with 28,000, so a further 12,000 now needs to be split in that PSR of 1:1. That, of course, will be 6,000, 6,000. So, oops, don't actually need an underlining of that. We have got so far £22,000 allocated to partner A and 18,000 allocated to partner V. So that's the old agreement up until the 31st of August we've sorted. So all we need to do now is to record the equivalent information for the period for which the new agreement ran, and that of course was from the 1st of September 20 through to the end of the accounting period, the 31st of December 20. Now again, remember, if you're dealing with an objective testing question, you do not have to be as fulsome as I am being here in terms of the information you put down. With a Section A objective testing question, you live or die based on have you picked the correct answer, the correct letter there, not on the strength of your workings. So although these can be abbreviated, and of course they must have to be, you don't have time for all this presentational gumph here, you need it in Section C. But for Section A, it's just you still have to carry out this process. You must still be mechanical and structured and organised in your approach. But you don't need all this background information. You know what work needs to be done. You do it. You're focused on this information here, these numbers, not the language that explains the work that you're doing, because that doesn't get seen in a Section A question. Okay, so the new agreement, the last 4 months of that period. So we want the remaining 4/12 of the, £60,000. And that therefore will be the remaining 20,000 out of the £60,000 profit now to be split. Again, the first part of that, salaries. And of course, last time we took 8/12 of the then annual salaries. We're now talking about 4/12 of the new annual salaries, and they are both £24,000. So 4/12, 1/3 of that will be 8,000 credited to each partner. That's 16,000 in total, meaning that you end up with a balance of 4,000 out of the total of 20,000 here to split in the profit sharing ratio, and that revised PSR was 3:2. So divide the 4,000 by 5 and split it 3/5, 2/5, and that therefore will, I think, be 2,400 and 1,600 respectively. That therefore will give us for this period, 10,400 and 9,600 respectively. But of course the figures that we want overall is how the total 60,000 tax adjusted trading profit of the accounting period, how has that ended up being split between these two partners A and V. So look at what we got. We had 22,000 and 18,000 respectively there, to which we're now adding 10,400 and 9,600. That therefore will give us for A 32,400 and for V 27,600. Again, just do a quick crosscast to ensure that that comes to 60,000. We haven't done something silly with our numbers. Again, a lot of use of calculators going on here, and we've got to be careful that we press the right button. So just do a crosscast to make sure that what adds down also adds across to that total there. And what that would mean, though it may not be required in your exam question, if it is just a Section A question, but what you now know is that for this continuing business, for the year ended 31st of December 20, which will be assessed using CYB in the 2021 tax year, £32,400 will go to the income tax computation of partner A, and 27,600 will go to the income tax computation, again for the 2021 tax year, for partner V. We have now successfully, we hope, divided out that profit using the profit sharing agreement in force during the accounting period. It was, of course, the profit sharing agreements that were in force during the accounting period. And the only thing you've got to watch for, the only thing where you could make a mistake, choose not to, of course, is time apportioning where you have had the change, salaries and interest on capital. Remember, they are given on an annual basis. You need to know how many months worth of each in each part of the accounting period on the old and on the new agreement. Okay, well, having watched me work that class example, time for you to have a go at a problem which deals with, of course, not just the same profit sharing agreement that is enforced throughout the accounting period, but one that changes part way through the accounting period. It's very simple to deal with, as hopefully you would agree with me now, inasmuch as the profit, that tax-adjusted trading profit of the accounting period concerned, must be time apportioned before allocation under the different agreements. How many months on the old agreement, how many months on the new. The critical issue there, as you have seen, is to ensure that when it comes to time apportionment in relation to salaries or interest on capital, what we must always do is to give a time apportioned figure of salary or interest on capital. You don't give a full year's worth of salary for only 6 months worth of the accounting period. You must time apportion accordingly. What does example 1 ask you to do? Show the allocation of those trading profits, as adjusted of course for tax, for the accounting period ended, here now as we're up to date, the accounting period ended 30th September 2020. What are we told happens? Our two partners, Doug and Rob, trading income for the year ended 30th September 2020, again as adjusted for taxation, £18,000. What has happened, of course, is that only up to the 30th of June 2020 were profit shared on, shall we call it the old agreement, which was simple, shared between Doug and Rob on a basis of 3-to-2 apportionment, profit sharing ratio of 3-to-2, after, of course, having paid salaries of £3,000 and £2,000 per annum. Remember, we'll credit any salary figures, any interest on capital, firstly to the partners, before dividing any balance that exists in that profit sharing ratio. But from the 1st of July 2020, we then change. Profits are now going to move to a PSR of 2-to-1 rather than 3-to-2, and the salaries have been increased to £6,000 and £4,000 per annum respectively. Okay, so we look at the accounting period. At this point, there's no reference to tax years, bases of assessment. What we must firstly do is to establish for each accounting period how much profit each partner has been credited with. Then, once we've got the figure of profit for a given accounting period, we can then apply our relevant bases of assessment. So what's happened here? It was the year ended September 20. The change occurs 30th of June 2020. So in which case, therefore, the agreement runs through to the 30th of June 2020 from the start of that accounting period. It was the year ended 30th of September 2020, so it would have begun on the 1st of October 19. So from then, the 1st of October 19, through to the date of change, as you see there, the 30th of June 2020, we have the old agreement. How many months is that? Well, that's 9 months. So of those salaries that you see here for our two partners, Doug and Rob, 9/12 of each of the £3,000 and £2,000 respectively will be credited. Then any balance in the old profit sharing ratio, which was 3-to-2. Having dealt with the first 9 months, we then deal with the last 3 months from the 1st of July 20 through to the end of the accounting period, the 30th September 2020 there. What will we have? Salaries, £6,000 and £4,000 per annum. So this time, that is only 3 months, so there'll be times 3/12. Once we've got those figures, whatever profit remains will be split now in the revised PSR of 2-to-1. Okay, time for you therefore to exercise those skills that we saw illustrated with the previous example. I've given you what the time apportionments have to be here in relation to this example, 9/12 and 3/12. Over to you guys. Finish it off, then come back and join us and we'll review through the answer to make sure we got everything right there so far as this technique is concerned. Okay, well, hopefully the answer that you've produced and that you're looking at now is remarkably similar to the one that we see in front of us on the screen. Should we call it the model answer there? But again, the process. We need a total column and a column then for each partner that has been a partner at any point during the accounting period in question. Now that here was not an issue. Doug and Rob have continued to be partners throughout the accounting period. A little later, what we'll be looking at is what happens when either a new partner joins the partnership and or an old partner exits the partnership. How do we deal with those guys? But what we have here, the accounting year end in question is the year ended September 20. We know what the tax adjusted trading profit is, £18,000. All we've got to do is to divide it according to the agreements that were in force during that accounting period. So we know that from the 1st of October 19, the start of that period, through to the 30th of June 2020, it was the old agreement, shall we call it. And that was a 9-month period, so 18,000, 9 months thereof, £13,500 is now to be split. What gets first share of those profits? Any salaries. Thereafter, any interest on capital, and only then any balance in a profit sharing ratio. Here there's just the salaries. They were £3,000 and £2,000 per annum respectively, but we just take 9 months of those salaries. So that therefore should give us £2,250, 9/12ths of 3, 9/12ths of 2, 1,500. Add the two together, 1,500 and 2,250 is a grand total there of 3,750. 3,750 out of an available profit of 13,500. Therefore, if we've already accounted for 3,750, what is the balancing figure then to be split in that profit sharing ratio? Answer, 9,750. So we come back to that £13,500 figure you see there. How is it to be split? 3-2 was the old PSR. Well, get your calculators out and get your figures sorted. 3/5 and 2/5 respectively. Hopefully will equal 5,850 to Doug and the remaining £3,900 to Rob. Add up what each has so far. 8,1 plus 5,4. Add those two together. Does that come to £13,500? Yes, it does. Just check your numbers. This is hugely computational. There's very little theory at work here. It is a simple system. Divide out the tax-adjusted trading profit of the partnership for the accounting period in question using the profit-sharing agreement or agreements in force during that period. That's it. That is the theory. So it's all about then making sure that you crunch the numbers correctly. So make certain that you get those correct time apportionments. And here, just check back to make sure that you can verify the total figure that has been split between the partners. So that's the first 9 months dealt with. What about the last 3 months? Well, 18,000 at 3 months is £4,500. What do we do with it? Well, salaries, 3/12ths of those salaries, which were now respectively £6,000 and £4,000, giving us £1,500 and £1,000 individually. Put them together, we've got a total of £2,500 allocated out of £4,500 in total, leaving therefore as a balancing figure to be split in the revised PSR, here 2-1, a balance of £2,000. That gives us therefore, not quite nice round numbers, but 1,333 and 667. Don't, by the way, immediately doubt yourself because it's not a nice round number. Life seldom works in nice round numbers, so don't think you're wrong just because it doesn't come up with a nice round number there. If you've applied the techniques correctly, then the answer is what it is. Don't start doubting yourself just because it hasn't got a 0 at the end of that number. What do we now do? Well, again, just cross-check. 1,667 plus 2,833 allocated to each of the partners. Does that come to our grand total, 4,500? Yes, it does. At least if my maths is correct, it does. We've got the whole £18,000, therefore, that we see here. And if we add 8,1, 2,833, 10,933, for Rob, 5,4, and 1,667, 7,067. Add those two cross-cast back, and we get our £18,000. What does that tell you? It tells you that for the accounting year ended 30th of September 2020, Doug has made a tax-adjusted trading profit of £10,933 and Rob £7,067. Those figures are therefore now what are to be assessed using the relevant basis of assessment for each of the partners concerned. Each partner, as we see written here, will be assessed on their share of the profit in, as you can just about see under there, 2021. Why is it that? We're using the normal current year basis. These are continuing partners, it's a continuing business. There is our year end. Year ended 30th of September 20. What tax year does that fall in? That falls in the 2021 tax year. So that is our year of assessment. So to the income tax computations of each of Doug and Rob respectively, we will take a tax adjusted trading profit of 10,933 and then £7,067 respectively. Okay, have a check back through that, make sure that you are happy with it before we continue on to the next issue that needs to be dealt with. Well, an issue that we've already mentioned but is referenced here in section 5 is of course that in deriving the tax adjusted trading profit that then we've split between the partners using that agreement in force during the accounting period, having in the adjustment of profit added back depreciation as a non-allowable expense, we will then have replaced that with a deduction for capital allowances. Now again, that will be done for the partnership. What expenditure on qualifying plant and machinery has been incurred by the partnership, and the partnership will get its capital allowances, deduct from the adjusted profit to give you the tax adjusted trading profit. Only then, having got that tax adjusted trading profit, do we split that figure between the partners and use those individual profit figures assessed to each individual partner in determining in which tax year will that profit be assessed. Point about capital allowances though that we need to make here is that each partner is an unincorporated trader, is a proprietor. Therefore, the issue that we dealt with in Chapter 5 of private use of a business asset by a proprietor, back then it was the proprietor, most likely, of course, a car provided for use within the business, but that is also used privately, then we know, in terms of adjustment of profits for the unincorporated business, whether sole trader, whether now partnership, any private use expense would be disallowed. And so too, in the capital allowances computation, would you need to maintain a separate computation for each such asset with private use by each and every partner. Each is the proprietor, a proprietor of the business. We treat them just as we would a sole trader in terms of the capital allowances computation that we put together. So, as it says here, if assets are used privately by the partners, then as we dealt with already in Chapter 5 for a sole trader, only the business proportion is included within the capital allowances computation. Now, once you've got that tax adjusted trading profit, as we've seen, as with the previous example, example 1, we then divided that figure between the partners using the agreement in force during the accounting period. And the only thing that made that division a little bit more interesting was the fact that the agreement changed partway through the accounting period. What we're going to deal with next, which we'll introduce at the end of this lecture now and then deal with examples on in our next lecture together, is what happens when the partners themselves have a change, i.e. an old partner leaves the partnership and or a new partner joins the partnership. What we have therefore is when a new partner joins, for that individual, that is a new business. So having, as we do for any accounting period, split the profits using the agreements in force during the accounting period, one with the previous number of partners, the next bit for the final bit of that period, after the new partner has joined, with the extra partner involved. Once we've got their figure, each individual partner's tax adjusted trading profit, we need to assess it. And at the moment, all we've had to deal with is somebody who's been a partner throughout that period. It's a continuing business. So what do we use? We use current year basis, CYB. But if a new partner has joined the partnership, then as far as they're concerned, that's a new business. and therefore we've got to use the opening year's bases of assessment. It is they that will apply to the individual new partner. And equally, if a partner leaves the partnership, then having got their tax-adjusted trading profit for the part of the accounting period up to the date when they leave the partnership, we have to deal with the closing year rules for the cessation of a trade, but just for that individual. So far as that individual is concerned, they have ceased trading. So we have to apply the bases of assessment for that individual partner that exist, that apply for the closing years of such an unincorporated business. So we're able to be tested here within the same example for the same accounting period. Partners who were partners at the start of the period, partners at the end of the period, continuing partners, they, once we have their profit for that period as a whole, will be assessed using CYB as an example 1, and in the classwork example we did prior to that. But if we got an old partner leaving part way through, then that individual needs to be assessed for the relevant tax years using the rules that apply in cessation, in closing years. Those bases of assessment apply, closing year rules apply for that individual, for the profits that they've made for their respective periods for which they've been a partner. New partner coming in, from the date they join the partnership, that's a start date. For them, that's a new business, they have started to trade. Therefore, from that point onwards, bases of assessment in opening years are applied for that individual share of the overall tax-adjusted trading profit of the business. That's laid down here. The rules for commencement and cessation, when either a partner joins or a partner leaves the partnership, exactly the same as we've used for a sole trader. What do? The profit is allocated between the partners for accounting periods, not tax years, for accounting periods, and then the assessment rules are applied. Only having divided the profit of the accounting period and got each partner's share, do we then pick up on, so what basis of assessment do we now use? CYB for continuing partners, opening year rules for new partners, closing year rules for any old partners exiting the partnership. As we know, each partner is effectively taxed as a sole trader on his or her share of the adjusted trading profits. As we've just said, continuing partners will be assessed using CYB. When a new partner joins a partnership, they're treated as commencing a new trade, and hence opening year rules apply. When we call him an old partner here, leaves the partnership, that's cessation of trade for that individual, and hence the closing year rules apply, again purely for that partner. Each partner has their own overlap profit available for relief. So again, on the new partner coming in, when we go to first tax year to second tax year, there's going to be some sort of overlap period. Again, depending on the accounting date, of course, of that particular business. But that overlap profit is specific to that individual partner. And when we deal with the partner, that one leaving the partnership, overlap relief will then apply on cessation in determining the assessment for the individual partner concerned. Just one final point here for this particular lecture. As long as there's at least one partner common to the business before and after the change, the partnership itself continues. The commencement or cessation rules apply only to the individuals joining or leaving the partnership. So in any one accounting period where you've got a continuing partner, CYB rules apply. New partner coming in, opening year rules apply. Old partner leaving, closing year rules apply to their particular figures of profit. To be able to deal with a problem of that nature, you have to be very structured in your approach. What do we do first of all? Look at the accounting period, divide it into old and new agreements. Now it's going to be old partners and new partners, not just a change in how they divide the profits between them, but now a new partner coming in and or an old partner going out, that's a rather more fundamental change. Get your tax adjusted trading profit for each partner for the full accounting period. Any continuing partners, just use your normal CYB that we've already seen. But for your new partner, start dealing with them from their start date. What is that first tax year of trading for that partner? Use your opening year bases of assessment. The partner who's left during the accounting period, what date did they leave on? What tax year does that fall in? That is their final tax year. Work from there to establish the bases of assessment in the closing years for that exiting partner. So again, it is about a structured approach. Absolutely vital here that we don't try and cut corners. We are going to have a structured approach dealing with the process in the way that I've just explained, but as I will be able to show you in our next lecture together when I'll take you through an example.